Welcome to the Dividend Thought Podcast, episode 107, quarter two earnings. Hey guys, welcome back to another episode of Dividend Talk. Today, European DJI and I will talk about earnings from companies such as Johnson & Johnson, Snap-on, Verizon, and our favorite AT&T. All that and more. See you on the inside. Hey, European DJI. How are you this Friday afternoon?
I'm in a really jolly mode. It's been a great week, and I'm really looking forward for today's show. But how about yourself?
Good, good. It's been a long week, I have to admit. Um, Earnings really starting to get into the flow of it now, and I've only started to catch up today, so I'm really excited. The next 2 or 3 weeks, I'm going to spend most of this weekend and next week catching up. But it's hey, we got some big hitters with results this week. I'm looking forward to digging into them.
Yeah, definitely, and it's nice to see. And I said I always like it when there's some fireworks in the stock market, right? Makes it a bit exciting because our investing is already boring enough. Our investing style.
Boring dividend investors, isn't it? But hey, look, we'll try add a little bit of fun to it. But hey, from the news of the week, is there anything you've seen across the world?
Well, not really that much because I've been working a lot. I heard that the ECB wants to do something again. I heard that the UK needs to pay more for Brexit. But for me, this is kind of like ins Westen nichts Neues this week. But how about yourself?
Yeah, I kind of noticed during the week, Walgreens took a. I know they've been on a bit of a downward spiral, but there was a small bit of a spike during the week, and it turns out that Amazon, as soon as they try get into a market, I mean, everyone fears they're going to take over, but I think they are looking to buy a company called One Medical. So
Mhm.
they are continuing with their march into the US healthcare market, so to speak. The interesting thing about this company is it's a loss making company. It doesn't make a whole pile of money, but I mean, I suppose investors get spooked, don't they, by Amazon coming in and taking over. So it's an I mean, it's an interesting one for Amazon. How they're going to turn this company around, how they're going to penetrate this market, and how they're going to compete against companies that are already there. But for me, it looks like companies such as CVS and Walgreens and to a larger extent Teladoc Health probably don't have an awful lot to worry about in the immediate future.
Yeah. Yeah, I don't really understand, honestly, what it is with American culture that they want all these healthcare and wellness things in shops or something like that. Remember with what is it from the book from Bad Blood, Theranos, that they
Yes.
were with, was it with Walgreens trying to make such
Yeah.
in shop experience or something like that.
Yeah.
I mean, even the term experience in shop, like why can't people just go to a doctor? Is it like people everything need to do from the parking lot opposite the Walmart? Is that really it?
It's more of a convenience thing, isn't it? They want to, I get it. I don't get it. I don't get that culture. I don't get that side of it. If I want to
Yeah,
go get a blood test, I don't
yeah,
want to walk into a shop. I want to go see a doctor. I mean, that's
exactly. You want to see a professional, right?
yeah. I want to see someone that's trained. I don't want to put my finger into a machine by somebody on 10.50 an hour working in a shop. It's
Exactly. Yeah,
so. I mean, I don't get it, but it's that part of the world and their culture, and Amazon are trying to break into
yeah,
it, but I don't think it's easy to just break in and I mean, they're not doing anything disruptive. They're buying
yeah,
broken or run down businesses and trying to penetrate that way. Maybe they're trying to evolve them, but I don't see a clear plan
yeah.
or vision on how they're going to do that.
But I think American companies see a lot of opportunity in the healthcare space, right? Also,
Yeah,
what
of course.
Warren Buffett and Amazon and such try to do with healthcare, right? And
Yeah,
healthcare provider, they canceled this initiative eventually. And I think just the costs seem to be really high there. And we see that always when we look at the earnings, right? And the earnings numbers, revenue numbers, it's always the US versus the rest of the world, and it's almost equal.
Yeah.
So definitely healthcare costs are really high in the United States. So I think they probably see it as a land of opportunity to do something in a different way. But in the end, I think they can try things from left and right, but they should just lower the cost for doctors and medicine, because that's insane. Why do you need to be a millionaire as a doctor there?
Yeah.
There's nothing entrepreneurial really in this. It's a result of education and then hard work. But how many people educate themselves and then go for hard work? Yeah, it's really awkward in society.
Yeah.
Yeah.
But I mean, on the flip side of this, if you were a shareholder and if you're
Yeah, as a shareholder, I'm happy.
yeah, and if you're a shareholder on One Medical, you're definitely happy. I think they're paying a 76% premium on the share price, which is quite quite interesting. So if you are unlucky or lucky enough to be a shareholder on One Medical, you're making 80% on your money straight away.
Yeah.
Look, it's a relatively small deal. It's 3.9 billion. It's mad to say that's relatively small, but for a company like Amazon, it is. So
definitely. But Amazon had also invested in Ring, this doorbell at the time, right? Was it also Shark Tank, something like that?
Yeah.
I mean, this is for me like the AirPods, right? Those they turned it really quickly, but I sit in a revenue generating business really like a lot. There's a good fit because Amazon for us is still like online shopping, and tech
Yes.
really fits with that, right? Electronics. So this is still like different.
Have you used or seen anyone with that doorbell Ring?
Yeah.
It's very, very good. I mean, we have neighbors here, right? And they were in Australia, and somebody actually came up past. It's a quite enough area, so there's not a whole lot goes on. But somebody actually came in and tried to open our doors, and I noticed something off at my handle that morning, but I didn't pay too much attention. He rang me from Australia and sent me video footage of somebody in his garden looking, and then coming down into my garden from a doorbell.
Yeah.
That was just insane. Do you know what I mean? And I could get a sort.
Yeah. Because this doorbell is actually monitoring, and you can configure the distance, and for instance, where I was at the other time at the place, when passengers were just walking on the sidewalk passing by, it could catch it and then make a quick recording. I was only thinking about privacy, but they have the sticker on the window that Ring is monitoring this, and I think that's why they can get away with it.
But the video was really clear, and
it's high resolution.
This was in the middle of the night as well, so I couldn't believe how clear. And so I think I'm going to buy one. I'm going to be a customer, I think.
Nice. Yeah. I was looking at them with Amazon Prime Day last week, actually. I didn't pull the trigger because my doorbell still works. And that's where my frugal savings rate thinking comes in, because it's July and I have my savings rate target for this month. So
awesome. Hey, let's kick off earnings week then, and who better then to start with than Johnson & Johnson, one of our favorites. And one of our sayings on the show, and we've said it quarter after quarter, is that they're like clockwork.
Yeah.
And I know, right, because we've talked about this, but I know you're starting to change that mentality a little bit.
Yeah. So first of all, and by the way, really good that you bring this topic up, right? So first of all, they slightly lowered their guidance. I think bottom line, that's probably important to know. The stock didn't really do anything. But let's start talking about clockwork, right? Because I would like our listeners really to realize what I'm reading in the numbers, right? So if we look at it, the sales are up by 3% year over year, right? And so 3%, this is approximately 700 million. If we then look at the sales of the pharmaceutical, they are up around 900 million. So 900 million, and it's their largest business segment. It brings in approximately half of their revenues. The other two business segments, consumer health and medtech, are effectively flat or even slightly down. So pharmaceuticals really driving it. The other two business segments not. If you then go to those pharmaceutical segment, they have around 15 segments under pharma, like drugs, let's say 15 drugs, relatively well diversified, that are generating the sales. Now, if you look at the total number here, first of all, $500 million is only because of COVID-19 vaccines and because of international segment, which is Europe, as an example, the Janssen vaccine, because this was already in the numbers last year with the US. So there was not really a lot of difference compared to them. Yeah, so if you exclude COVID-19 vaccine results, we're talking about a nearly, well, let's say 150 million more. So really relatively little. And 300 million more in the US. So we're talking then, yeah, after deducting, let's say,
Yeah.
400 million to half a billion from COVID, we have half a billion left. And guess what? Only one product is taking this whole increased revenue on its own shoulder, and it's Darzalex. Darzalex is a biologic for the treatment of multiple myeloma. So I believe it is this skin cancer from the sun, I believe.
Yeah.
So what we're talking here about, actually, that their entire revenue and profit dependency is on COVID-19, which we know with the Janssen drugs might have been a bit of a one-off because it's not I said our vaccine, it's not a popular vaccine, and the other one is by one single cancer drug. So if we talk about clockwork, right? What I would like people to know is that, okay, the company is really well diversified in the pharma business, but there's only one drug in that pulling it off, and this drug is making 1.9 billion, is twice as much as the second best-selling drug. So the dependency on a single drug is only increasing with this growth, which means that for me that the earnings risk is growing. Therefore, I'm afraid that if they don't get more strength in their pipeline, that this clockwork might change over the next 5 years.
Yeah.
So this company is not anymore this company that is firing on all cylinders, growth everywhere. No, it's effectively a flat and a dead business, except for one drug and a COVID-19 vaccine windfall. And this is for me a bit like in the context of know what you own. For this, you need to read a little bit more into the numbers, the financial statement. But I think what is with a company like Johnson & Johnson, there's this narrative with everyone like best dividend stock ever. Yes, historical performance, definitely. Oh, you can sleep well at night. Yes, it's diversified well enough that this is a slow compounder. It won't lose suddenly 40% overnight. But if we look at growth and if we look at the future and the predictability, this is changing, specifically also with the spin-off of the consumer health. It becomes a biotech company, and with that, you have all the patent risks, and you get what you get at a certain moment to a situation where they need to maybe take a lot of debt on to buy another pharmaceutical company, like what AbbVie has been doing and such.
Yeah.
So this is the future ahead of them, in my opinion. So yeah.
Yeah, like you mentioned, know what you own and look at the numbers, and that's fine. But what I really don't really have a good grasp on is how strong their actual pipeline is. What's the pipeline coming through? I don't get a sense that it is that strong. I'm not an expert in that field or in these markets, but I don't get the excitement or the buzz. I don't have a feeling that they have a strong pipeline coming behind. And certainly when you flick through the reports and flick through, they don't give me that impression either. Like if I look at Rush, for example, you always get, I mean, they're talking about new products. I'm not getting that sense from Johnson & Johnson. And for me, that's quite scary because you have to look forward, not look back. And if you were to look forward, yes, you look at the numbers, but you got to get a sense of how they're going to grow that.
I think in the boardroom, if you walk in there on a given day, I think they're just with their head and their arms on the table, sleeping and snoring. I mean, I think this is what Johnson Johnson is. I think the people, the management fell themselves asleep, I think.
Yeah, but I mean, it's easy to get complacent, and look, it's hard to keep a juggernaut like this keep rolling.
Yeah.
It's hard to keep it rolling. So maybe they've taken the foot off the pedal, and they might need to experience some pain before they make changes. And
Well, you know how they did in the past, right? With the opioid crisis, talc powder. I
Yeah,
mean, it's not like they have a clean sheet when it comes to business management practices.
just spin it off, baby.
Yeah. No, but this is also Johnson Johnson. So yes, iconic dividend growth company, triple A balance sheet, nothing to worry at all there. Well diversified, it will not lose, but it is becoming a one-trick pony. And with that, over the next decade, we will see increased risk in this company. It is not anymore your grandfather's company.
Yeah, I mean, as dividend investors, and certainly in the community or the wider community, maybe not so much the European community, but definitely the US, we have to come away from these dividend aristocrats as being safe, predictable companies. I think we are changing. The world is changing. The landscape is changing. So we need to be aware, and we have to try and stay with companies that will evolve with the times rather
Yeah.
than put their heads in the sand. So, look, at the minute, there's nothing concerning in the numbers. It's just a pipeline and where they're growing that's concerning. So maybe 3-5 years from now, we might start seeing some pain, but for the moment, I'm still
For the moment, it's
expecting
fine.
I'm
Yeah.
still expecting the 5-6% growth that we've been seeing quarter on quarter.
Yeah. Definitely. What I would like to say is it doesn't deserve the multiple it currently has, in my opinion. I would love to see it more trading at 140. It's probably around 170. So if it's in the 140s, consider me a buyer.
Yeah, I can't remember the last time it was in 140s, back 2020 maybe, but yeah, hopefully,
Yeah.
hopefully it'll come back. We'll see.
Yeah.
Okay, what about your second favorite company, Strap On? I think you called them at one point.
Yeah, Snap on the drillers, right? So look really quickly about this one, right? It got brought up by a listener, one of the social media followers as well. I like it. It's kind of Black and Decker, right? Snap on. It provides tools and such
Yeah,
for man effectively. And I'm just impressed with this company. The more I read about it, sales up 5.1% or 0.1% year over year. Organic sales 8.4% because there are currency headwinds in there. I said, and then diluted EPS of 4.27 right now, 13.6% up. I mean, talking about a boring company, yeah, and really a boring one, and also having tools for what is called in Dutch a boor. Um, I mean, these are stellar growth numbers, right? And this company has been paying a dividend in uninterrupted, I believe, since 1939, and
and
this is really stellar.
we were quick to write this company off. Remember when it came up first? We
Yeah,
were
yeah,
very,
yeah, yeah,
very quick. And to
yeah,
be fair, somebody, well, I'd say somebody. I've had a lot of people reach out to me since and have said, guys, you were completely way off the mark. You were wrong. Look into the numbers. Look into the numbers. And I think you were away with Thiago when I eventually did. And honestly, all the numbers pass my criteria. And from a metric point of view, 100%, they should be on my watch list. I still have yet to dig deep into the business model, and can it keep growing at that rate? But
yeah,
but honestly, from a numbers point of view, I can see why everybody likes them. Their numbers, their growth rates are impressive. Their dividend growth rate, their free cash flow growth rate, very little depth as well. So it looks like a genuine contender for my portfolio. I just need maybe a day or two to sit down and get through some annual reports before I pull that
yeah.
trigger.
For me, it would still need to dip a little bit because I believe the dividend yield is somewhere in the mid 2%. But forward PE of 13 is really not that bad, right? So there's also a relatively low payout ratio. So yeah, I'm really, really happy from what I'm seeing. And for me, it's definitely on my radar, this company.
Awesome.
And any company you would like to talk about? How about, for instance, another pharmaceutical?
Yeah, let's talk about. I mentioned Roche earlier, so let's talk about these guys. The first thing I want to maybe highlight is that they are now changing their CEO. The current CEO, Christoph Franz, I think I pronounced that, has decided not to seek re-election from March 2023, which is a little bit of a shock. I have to say, he's still quite young. But what is interesting is the new CEO coming in. I think his name, and you might be able to pronounce this much better than me. But the current CEO of the diagnostics division is Thomas Schneiinker.
Schinecker.
Schinecker. Okay. Which I find fascinating, because if you look at Roche's two divisions, yeah, they got the pharmaceutical and the diagnostics, and the pharma division way outseeds the diagnostics in terms of revenue. So it's a much bigger division, but yet they overlook the CEO of the pharmaceutical division to go with the diagnostics division. But it's honestly, if you were to look back over the last 2 or 3 years, it's easy to see why. That division has been grown double digits and high double digits, 30, 40, 50% over the last 3 or 4 years. COVID-19 has helped massively, but even look at this quarter, it's grown 50%. I mean, that's huge numbers. So this guy seems to be well liked. He's pulling really good numbers in the diagnostics division. So he seems to be a good fit for the company. But looking at their actual performance, I mean, look, it was quite. The pharmaceutical division declined a little bit. They're still saying COVID-19 is having an impact, and there's also some biosimilars that's impacting their top line. They are drugs like Avastin, Herceptin. But the good news is that 50, I think the last time it was around 45, 46, but now over 50% of new products is accounting of the revenue. So we can see new products are starting to come through, are starting to build up revenue, and I'm pretty sure that will return to growth. But it's the story of the diagnostics that's really impressive. The growth there has been phenomenal. And they also actually just added, they have also committed, as they have last quarter, to increase in the dividend in Swiss francs as well, which is pretty good.
Yeah, super. Well, I've in the show notes you put the picture of the pipeline here of the portfolio.
Yeah,
What's really nice to see is that 3 products are really declining because of biosimilar impact.
yeah,
But then there are like 5, 6 products really with good sales behind it. So it means like they are getting more diversified and therefore probably lowering individual drug patent cliff risk, right, in the future, a
yeah,
decade from now, let's say.
yeah. I mean, look, they were very aware of the risks that they had in terms of the top 3 or 4 drugs, and now they've brought in, I think I count eight drugs there that are doing really well in terms of revenue, have plenty of room to grow. So I have
Yeah.
no fears for this company over the next 10 years.
Yeah, super. So maybe then also switching a little bit up north from Switzerland, let's go to ASML. Many people in our community love ASML, and I also did a video on it not too long ago. And ASML's numbers were not so good as expected. It had to do with the free cash flow numbers. So first of all, that 5.4 billion in sales, remember that number, 5.4 billion, because they gained new orders of 8.4 billion. That 8.4 billion will be, let's say, accounted as revenue, let's say 2-3 years from now. So if we have an order rate that is like 40% higher than the revenue coming in on a quarterly basis, wow, there's a lot of wealth coming our end, right? Because all these orders need to be fulfilled in the future. But EPS 3.54, last year 2.52. So it's a really big jump. But the free cash flow is 5.82 versus 8.08. And this is, I think, really important to know, because their working capital impacts what they have been doing. And this will be a story also later with some of the telcos that we are talking about. But there are heavy supply chain issues in this industry. So there's a video about the CEO, which is saying like, okay, guys, what we are doing now, we are testing at the customer side, but we can only recognize the revenue after the tests have been completed on the customer side. So in general, this cost them an additional month. And because of that, you cannot recognize the revenue, you don't get the payments and such. And that's why there's a free cash flow hiccup currently. And inflationary pressure they have been talking about as well. And we all know what's happening in the supply chain here. So that's why they have free cash flow issues. And this is also why they are lowering the margin guidance for the upcoming quarters, because they now need to, I said, go through this bulk of changes that they made in their operational business. But this will smooth out again next year. So it's a pain they will take now. That's why it's hampering a little bit at the moment the cash flow. But for me, I mean, you saw the share price response as well. It's already about 500. It really
Yeah.
first of all, it dipped, I think, in the morning, and then went up because people started to realize actually that, okay, guys, the management is doing really well here. It's a one-off. Lots of stuff coming. For me, just the margin, the net bookings of 8.5 billion blew me away, because this is just like 60% more than the actual revenue this quarter. This just blows me away. It's amazing.
It's crazy. And I mean, when do you think actually we'll stop seeing supply chain issues on these reports? I have contacts in this industry, and I believe that it's not as severe, these issues, as what we've been led to believe. It was initially, but I think it's definitely after tapering down. But I'm certainly from next quarter to quarter after not expecting to see.
Yeah, but when we say
this.
supply chain issues, we're also talking about production capacity.
Mm,
Look at Intel. Intel's investing in factories now, right? It's not just the chips that they need.
yes. Yeah.
So, and then you have, I said, governmental policies kicking in as well. So, I don't think it's anymore about a ship blocking the Suez Canal.
Yeah, but jeez, if they're still talking about that ship, I give up.
Yeah, but also Shanghai had a lockdown.
Yeah.
Nothing was happening there. We've seen the pictures about the ships in the harbor there that couldn't leave, right? So I don't know what your contact is saying and who it is. I have a feeling for it. But maybe this person is a certain side of the chip industry where it is just a bit better organized.
Yeah. Yeah, I also wonder the big short, Ray Dalio, shorted.
Oh, he's losing money now, right?
Yeah,
Unless he had a short squeeze on ASML.
I mean, we don't know what price he got in at, and that's the frustrating thing. I'd love to know what price, but I mean, my first thought, I just looked. They bounced from close to 415, and they're up past 530. So, I hope he did it at the top when they were 950.
Yeah, I hope he covered it.
Yeah, he has enough money. Maybe he doesn't need to.
Okay, so let's stay in technology. I want to talk about a shit show called SAP. So I did an article one time on SAP saying like the perfect company with lock-ins. Yeah, hence revenue is protected, and revenue is protected. If we look at it, revenue last year or year over year grew with 13%, which is good for a company that is in a transformation of shifting its licenses business into cloud. And it's successful in that. Cloud grew with 34%. It's now 3 billion. It's really, really meaningful. Software licenses is flat with 3.4 billion.
Yeah.
So that also means that an 800 million additional in cloud didn't really cannibalize their licenses business. Chapeau, yeah. But then I look at sorry for my words, by the way. I look at their sales and marketing, which went up with 500 million. Sales and marketing. So they burned all the cloud income revenue. They burned it on sales and marketing. What do you burn this money on? Is this entertainment?
I mean, or has that sales and marketing attributed to the extra revenue? Are they bringing in more people?
Yeah, okay, but
that?
if your revenue costs just as much as your sales and marketing budget, then what are we doing here?
But what they have done is they have, from what they said, that they've increased more of their predictable revenue. So their revenue is, I think it was 75, 76%.
So I hope that this
80%.
was a one-off in
Yeah.
sales and marketing, and that's really recurring after that. But I can tell you, I'm following this company now for 2 years, and it is every time something. It is almost becoming an AT&T story. In this case, the share price responded positive. And you know, SAP has just one luck, because now many people hate the software, and I'm talking about end users, not consultants, because they are counting themselves rich. Yeah, but they have one luck. if you want to migrate away from SAP, you need to be really, really doing this well, because it might even get your company into bankruptcy issues, because if you cannot claim your invoices and get them paid, because that's how integrated SAP is in the lifeblood of any company, almost where they are. So they have such a lock-in. That's their savior. But come on,
Yeah, look, it remains to be seen. I understand what you're saying, but the numbers don't look too bad. The share price obviously reacted positively. We can see that it's offset by sales and marketing. But if that does increase, then the amount of people lock them in, and now they have a more predictable. If they got 5% extra per quarter per year, that's still a lot of money. So they
Okay.
could make that
So
back. We
let's check next quarter, the
we
sales and marketing. For me to spend 500 million more on that in a single quarter, we are talking about increase of 28%.
yeah.
This is really, really. I mean, it gives me a feeling that they've been just having parties, booze, everything there in the main office. I mean, this is really a lot of market money.
It makes
And
me
cloud should be scalable, right?
it makes me want
SaaS
to be
models.
a seller of SAP products. I want to get in on these parties.
Yeah, exactly. If they say we give you 50% bonus of the revenue you generated for the first year, I'll apply now.
But I agree. It's something to monitor for next quarter, maybe the next 2 quarters, and see if that's a trend. If that's happening, then I would say yes, they're blowing money. A once-off quarter, I would not be concerned, particularly with the increase in revenue, increase in customers, and having that recurring revenue coming in is key. It's key to their business model as well. So it could be quite a shrewd move, or as you said, they could be partying it and just throwing it down the
Well,
toilet. But
yeah. So we're talking about if these are recurring costs,
yeah, yeah,
fixed cost. Bottom line, they decreased profit by 32%. Yeah, hardly any free cash flow. So, we're not really talking here about the most profitable business from that point of view at this moment in time.
yeah,
And the fact that the price went up, yeah, I understand the price was trading about 100 euros for a long time. And in the 80s, it is, if you look at SEC at the metrics, it is fairly valued, probably. So, and then for a cloud business, yeah, I can imagine that it goes up a little bit, because it was already really under pressure until now. Yeah.
yeah.
But I'm staying away from this company at the moment. I had it for a year. I threw it out of my portfolio again after I really understood what I'm having.
Yeah, I've no real interest in this company, and definitely at this price. Don't think they're attractively valued at all at this price, so I would stay away. But I'm still not quick to dismiss their sales and marketing. It might be a good tactic long term, but we'll keep an eye on it.
I hope you're right, and there's nothing wrong with investing for the future.
So you mentioned halfway through, you were talking about a shit show, and you talked about AT&T. So I think it's a good introduction into talking about these guys. I know you had a video out. You were laser quick on that. I mean, I think the earnings results just dropped, and it's like you had that pre-recorded. It was super quick, but I have to say, from the most part, I agreed with everything you had said. It's hard not to, I suppose, when you look at the numbers. But what's really, really puzzling is operationally, the business is growing. I mean, they're growing subscribers, the revenue is growing, their broadband subscribers are growing, wireless net adds are growing. So from an operational point of view, they seem to be doing the right things. They are growing the business.
Actually, they have done really well.
Yes,
right, compared to what we are used from them.
I like, if you were to just take it at face value, I think it's pretty impressive what they have done. But it's obviously they got hammered in price, and we know that's because they lowered their guidance in free cash flow. And even though they've lowered that guidance, it still seems unattainable that they're going to make an extra 10 billion over the next 2 quarters, considering they've only made 4, maybe just under 5 billion in the first 2. And that's where the problem comes in with this company. Is the CEO telling the slides? Does he actually think we're going to make this up? I mean, I'd rather just be honest now and say, look, we're not going to do this. We're going to cut this in half.
And they want to do 20 billion next year.
Yeah, I mean, that's pie in the sky. There's no way they're going to do that. I mean, the aim maybe 14 for next year is probably more reasonable. The problem here is, and you covered it quite well, is that their dividend is not covered, and we've already taken a dividend cut with the spin-off. So it's still a high yielding company, but the dividend doesn't look safe at the moment. We don't know what the board are thinking here. I mean, the dividend aristocrat status is gone, so they don't even have to protect that anymore. So, I mean, they might cut that. I can see that. I can see them cutting it.
Come
And
on.
it makes sense. It actually makes sense for them
Yeah.
to cut them. Looking at the numbers, it makes sense. I would rather them tell me straight to my face, we are struggling. We overprojected. It's not going the way we planned. We are struggling. Costs are going up. Working capital is going up. We don't have the money to cover this dividend. We're cutting. We're cutting that dividend, and our free cash flow forecast is going to be 10 billion, and that would be
Yeah.
realistic to me.
Yeah, but this CEO, it's really a problem with the CEO, because also if you look at the free cash flow, why is it so down? Because they brought investments forward. Also, again, business-wise, really good. If you're rolling out fiber and 5G, and you can do it, I don't know, twice as quick in a year, do it. Burn the money if you need to
Yeah.
burn it anyway. Yeah, you're anyway taking the debt and such, or you take it forward. The thing is, he's just all the time over-promising and under-delivering. And the last time, I would like to remind you that he told us literally like 1 or 2 weeks before the dividend cut that the dividend is safe. He told us, yeah. And for me, I mean, he's a, how do you call that? A pathological liar. I mean,
Yeah.
did you catch him ever on speaking the truth almost when it comes to the numbers?
I mean, what annoyed me, and I said it to you off air. Now we were flicking through. I was going through AT&T or going through other companies, but I was looking at the free cash flow, and I said, looking at the high level numbers, there's not a lot of difference in this year, last year. Yes, we've had the spin off, so there's going to be a small impact, but there's nothing blaringly obvious to me why it was so different. But you have to dig and dig and dig and dig. It's like they're hiding the numbers. They're not being transparent enough for me, and that's a huge problem for me. So I I agree. The CEO, look, he's just not good enough for me. He has to go. I'd rather someone be straight, tell the truth. Yes, the share price might get hurt, but I would much rather be invested in a company I can trust than not trust. So it's given me a big decision. I've still held them shares. I still hold them shares. Do I sell them now at a huge loss, or do I wait? Dividend is still high enough for me. That's all it is for me now.
Maybe just covered call selling.
Yeah, cover call selling is probably no. I do. To be fair, I do that. I do cover calls quite a bit. So it's
and they never get called.
No, they never get called. How can they get called when the share price keeps going down?
Yeah, I know. We all have such a stock in our portfolio, minus Alibaba. So don't worry.
But I mean, it's relatively small position. I mean, so it's okay. It's not like it's burning my life savings away, and holding for the dividend is fine. But I certainly wouldn't be adding more shares, and I'm certainly not happy with how this company is being run from the top.
You know, Buffett always said it, right? Your business model or your company should be that strong that any idiot can run it, because one day someone will.
Yes.
Yeah, an idiot. Now we have this guy now for how many years? 3 years.
Yeah.
Before it, we had, was it Bob Swan?
Bob Swan was Intel.
Intel. Who was it before him again?
Well, I'd have to look that up.
Yeah, also a guy that we were happy to see going. Yeah, but I mean, this company has now been run by idiots for the last 5-6 years. And when I say idiot, it's probably not the nicest word to say. But what I really try to say is people with a big dick, because they got this, like, we need to buy these, we will be a media business. Yeah, we will be this, we will be that. And then massive debt. And then they need to offload it again with DirecTV. Yeah, but the debt stayed on the balance sheet, right? Then a spin-off as well. And now we're like, after this whole like boom and bust cycle in their ego and their acquisitions, we're left still with dividends that are not covered. Yeah, and we got a dividend cut at the same time.
And we talk about the caliber of CEO that they attract, and just thinking about the business and the business model. I'm not surprised, right? If you're an up and coming CEO and you have ambitions, why in God's name would you go to a company like AT&T? They are loaded with debt up to their eyeballs that they can hardly pay. The growth is limited and capped. The amount of capex that they have to spit out is enormous. Why would you put yourself into that situation? Go. You could go to a much better company
So
making
they
a name for yourself.
AT&T got the CEO it deserves,
Exactly.
but then it also got the investors it deserves.
Yeah. I'll take it. I'll take that one.
Okay.
Awesome.
Well, let's go to Verizon there. Same story. Also hammered today, 7% down. Declining earnings, 131. This time, 139. Last time, if you exclude the special items, otherwise it's 124 versus 140. So we're talking there about a 15% decline. Again, relatively okay. Some net additions in the broadband wireless service. I said grew 9.1% year over year. So from that point of view, it's looking relatively good. But then the outlook is a downgrade from them, right? They expect now, instead of earning $5.40 or 50 cents, $5.10 to 20 cents. So similar story with Verizon, just way more stable management, I would say. Free cash flow is still covering the dividends, so it looks all a little bit better at Verizon. If I would need to choose any of those, I would really choose for the stability of Verizon.
We can really see the difference in management.
Yeah.
I mean, again, operationally looks absolutely fine. I'm not surprised that they're lowering forecasts. I mean, like with the half year that we've had so far, inflation been so high, costs have gone up. I'm not overly surprised at that. I suppose the one big difference with Verizon is that their dividend is covered, and that's a huge thing. Their management have got this down to a T. Arguably, they're not as big as company as AT&T, but they're much better managed, and that's key.
Yeah.
Okay, and the last company I started to look into was Philip Morris, and honestly, I got so annoyed. I was ranting off air. I got through 40 pages of their presentation. I didn't see one number. Everything was like percentages. I don't care about percentages. I want to see hard numbers. Could not even find a cash flow statement or anything. So I really honestly I gave up in the end. I looked for their 8K on the SEC, and it wasn't there yet. Looks like from the percentages, it looks like they did okay. But they talked a lot about pro forma adjusted revenues and net income. I mean, what is that? I mean, it just got me so riled up and annoyed. I don't care. I don't care about these. I just want real numbers. Give me the reported numbers. I don't mind. Look, I don't mind adjusted numbers when it's currency, because that's fair, right? Because they have no control over currency. But I hate when they start throwing in pro forma adjusted and taking out all these events. No, just give me the proper numbers, and I can assess you.
Adjusted and diluted.
What does that even mean? I mean, look, I'm sure Dividend Wave is much more informed in this company and in this industry than me. He'll probably ping me with some facts and tell me how actually great they did. And it seems from the percentages it looks okay, but I just couldn't really piece together.
Yeah, and you're an investor, right? So
no, not in Philip Morris.
But what I mean, like, you're looking at it as an investor.
Yes.
So you would expect that they write this stuff for you.
Exactly. I mean, there's so many companies there that you like. I looked at Johnson & Johnson, and within 10 minutes, I knew what I was looking at. I mean, even AT&T, I learned more about them in 10 minutes than I did with Philip Morris, and that's saying something, because AT&T, I still had to take.
Exactly.
And yeah, rant over.
Okay. Well, not worth the energy further. Let's go to the listeners' questions.
Okay.
Yeah. So Boris Bulajic is asking what we think about Viatris at $9.68 and a yield of almost 5%.
I mean, I bought these guys at 13. I bought them again at 11 after they had announced that they're spinning off their company. And for me, nothing has changed in that time. I know they have earnings coming out in August, and we'll see if anything has changed. But I really like them at these. We were talking off air about put options, which give you attractive income. I can't recommend anyone to do that because it's risky. But I mean, to me, at a 5% yield, it's almost a no-brainer with these guys.
Yeah, yeah. And also the dividend is safe, a really low PE ratio. I mean, this company is really in the corner where it's getting beaten up by Wall Street. But for me, I'll take it. I'll take it.
I don't think it has to do a lot to jump 30-40%. Honestly, I think
Yeah,
it's just one good press conference away from jumping. I think it wants to jump because you can see it dipping below
yeah,
10 and it shoots back
yeah,
up. It's like it has its bottom, but for me, nothing has changed. I'll give you a better answer maybe on the 8th, 9th of August when they released their earnings.
yeah. Super. Then Alex, who was also on the podcast here, is asking about our thoughts about Defama as an investment. Would we like to add it to our portfolios?
So last week we had the CEO on, and I have to
Yeah,
say he was fantastic. And what I liked about him is he was honest, upfront, frank, pretty German. I would say that they normally are, but he didn't shy away from any question that we asked, either on air or off air. He was quite honest. And what I did like was he did highlight the risks. He didn't. He did try paint the company up a little bit. Let's be honest. That's his job. He's not going to go in there and say uh, really beat down the company, but he did not hide away from the risks. And I like that honesty. It's a market that I'm not 100% involved in, that I'm not up to date, but he gave us a clear picture of their vision, what they plan to do, how they make money, and I was quite interested. I am going to add shares. I think I have an order in for 22 or 23. I have about 50 shares just as a
yeah,
starter position. I want to keep following these guys. Keep up to date and see. And I mean, if his business model plays out, then I'm happy. And as he said, in this type of environment, these guys are going to thrive, aren't they? So it's
yeah.
probably a bad time to start buying them actually, because their price is going to be too high.
Yeah, so for me, the same. I have a purchase order outstanding for 50 shares for 24 euros. Didn't hit yet. I'm patient. I'm not in a hurry. Um, I just, yeah, +1 to everything you said.
Yeah, yeah. He said, look, we're talking about CEOs and we're giving out about Stinky up above, so we have to give someone credit when they come on and be honest, and they don't hide their
Exactly.
numbers, and even though their investor reports are not in English, really, you can go on and just look at the numbers, and
Yeah,
I'm clear from the numbers without even knowing German too well. I'm clear from the numbers what that company is doing. And as you said, he's been on both sides as an investor and now as the CEO of a company, and he does seem to have the investors' interests at heart as well. And look, he's a huge
he's
investor in that company as well. So
yeah, he's the founder and the main investor,
yeah,
26%. I was already thinking like you can just calculate what his dividends are on an annual basis, and probably this is just his income to live from. So I think really our incentives are really well aligned, because if he increases the dividend, he is giving himself a dividend hike
yeah, yeah, you give himself a
or
pay
a
rise.
salary hike. So yeah,
Okay, so Han Van Dyke. I hope you're related to Virgil Van Dyke. Actually, I meant to say that. That'd be awesome. But he has asked us what our opinion on Mondelez is. Obviously, we talk about Nestle, Unilever, Danone, but never really heard a talk about Mondelez.
I actually like Mondelez. Unlike Unilever, the company has grown its share price with 40% over the last 5 years. Not too bad for a consumer staple like that. It has indeed a really nice portfolio. It's last, let's say, 1.5 year, it has been a bit dead money, and I don't see this changing because it's trading at a 21 PE. I think it's too pricey for me. If it would come down to, let's say, low 50s, I might consider it. But until that time, not. I mean, you get it at a dividend yield now of 2.3%. It's also below my screener criteria. Payout ratio of 46%. So look on, it's actually quite simple for me. If this would be trading at a 3% yield, I might consider it for the quality of the business. You're right. I think it's actually better managed at the moment than Unilever. So yeah, those are my thoughts about Mondelez.
Yeah, we had somebody, was it Eli Snowball? We had somebody talk about them recently on our shows. That I mean, they are a quality company. They're in the same league in terms of brand power with the companies we've named, like Unilever and so on. So they are top quality. I don't think they're a bad long-term investment either. I know they're slightly overvalued and slightly priced, but if you're thinking long-term, then it's not too much of a problem. So you couldn't go wrong adding these guys to your portfolio. I mean, 10, 20 years, these guys will still be around.
Super.
Tim has asked us, what is our opinion on the next big global trends in the next 10 to 20 years, and how much do these influence your dividend investing decisions?
Yeah, so for me, it's anything we need to do regarding climate change. So the energy transition here, I still see Asia as really a booming population growth. I see also the boomers in Europe and America as a trend that you can play on. But let's take investing aside. I hope that in the next 10 to 20 years we could start thinking really about curing cancer. And why I'm taking investing aside because I don't know if the current pharma companies are the ones that are going to do this. But CRISPR and the technology, not the company, but the technology itself, I'm really, really hopeful for. And I have a feeling that the stars start to align, that we can really, really get to a situation with cancer that we maybe can get pills or medicines kind of as a prevention, and therefore kill it quickly without surgery and everything, and then just using our making biopsies, checking the DNA, give a targeted medicine, and just kill the tumor straight away.
But that's huge technology. Like AI is going to play a huge part in that. I
Yes,
mean,
definitely.
it's going to be, and that's probably one of the ones I was going to say is AI. Electrification as well is going to be huge over the next 10 or 20 years. But how does it influence your dividend investing decisions? That's
Not really. I do take, so for instance, I look at companies more. What are their tailwinds? And with that, I have always, when I think about that, I always have some global trends in consideration. So if I see, for instance, that an American-based company with majority of revenue there is on a really good track, but then doesn't really have yet an overseas business, yeah, then I see that usually as globalization as a trend. But for instance, Starbucks, I see the middle class growth really as a how you said, as bullish for the company in China and in Asia. Yeah, because maybe now not everyone can afford a coffee there, but 10 years from now it might be different if they really keep their brand power.
The concerning thing about trends and global trends is they can change quickly. They
Yes.
can change quite quickly, and you can get caught in that. And I'll just give you an example. On Twitter, 18 months ago, you had electric vehicles. So we know Tesla. Everybody knows Tesla, and Tesla are still riding high. But I mean, there was other companies that came from that. You had NIO, for example. You had a company with ticker symbol RIDE, which is Lordstown Motors. You had Solo Electra something or other. So you had loads of different companies, and the bottom has fallen out of nearly all of them except for Tesla. Tesla's day will come, and I've no doubt about that. But a lot of people were jumping on trends, electric vehicles, EV. There was blogs, there was everything talking just solely about electric vehicles, and it changed in an instant. So, I mean, global trends, yes, it's important, but it doesn't influence my decisions. It's something that I look at a company thinking, in 10 years, do they have the opportunity to grow? And if it's involved, if there is a global trend that would help that, I'm fine with that, but it certainly doesn't influence me.
No, but for instance, ASML, the digitalization of everything. Yeah, everything needs a chip.
Yeah.
That's how I look at
Intel.
yeah, that's how I look at it. But I don't look at it from the side of the trend looking back to the companies. I
Yes.
usually look first at the companies and then the trends.
Yeah.
Good. Then the question from Elo, Elo Huff, Elo. He's asking us about dollar cost averaging and the impact of commissions. He finds himself paying some 3 to 7 euro when buying, let's say, 500 to 1,000 euro of stock.
Yeah, I mean, look, commissions can't be discounted. It has an effect on your overall returns long term. That's quite an amount of money to pay. I'm with the Hero, and I pay 50 cent when I
For American stocks.
for American stocks. It's for something for 40,
Yeah.
sometimes for stocks in Europe, and sometimes with French stocks, it's actually more actually pay French tax. So it depends. It depends on what you're paying. I would say for a low income account where you're putting in a low amount of money, I would try keep the commissions to a minimum. That's and certainly when I was investing first with the Hero, I was buying 10, maybe 5, 6, 7 companies a month, and then I realized, oh, why would I bother doing that? I just buy one company, pay 50 cent in commission, and I'm happy. So
Yeah.
it's something I keep, but €3 is not bad. Consider some Irish brokers are charging you 25 to 50 euros. So it's
Yeah, I'm not so. If it's just a commission to buy shares, I find this still reasonable. Let's say 7 euro on 1,000. We're talking about 0.7%. What I want to avoid at all costs is maintenance fees, because those are the ones really long term eating your I say impacting your compounding. Because for me, this commission is a one off cost, and you will never need to look at it again if you hold the shares forever. But if you're, let's say, doing 500 to 1,000, that means you're like doing 6,000 to 12,000. I just would go indeed for a low commission broker like the Hero or Trading 212 or Interactive Brokers, because yeah, it's not worth the high commissions. To be honest, I know it's a lot of money for the individual, for Elo in this case. I can
yeah.
imagine that. But I would, yeah, specifically in these early days, I would really look at. Still, I think he has opportunities to switch broker.
Yeah, but there's risks. I mean, the
Yeah.
low budget, but they don't have the same safety as some of the other the most.
Yes, that's true. That's
So
the risk you take. Yeah.
so there's risks, and you got to weigh it up. Maybe with the broker you have, your
Yeah.
money might be safer up to X amount of money. So you just gotta weigh it up. I mean, all in all, it's not a huge amount of money if you consider 10 years ago or before digitalization, people
Exactly.
were being paying a lot more than this. So
No,
it's
but maintenance fees, that's what I'm really picky on. That's why I went away from Saxo Bank.
yeah.
They really costed me a lot on an annual basis. I was 600-700 euro or something like that annually.
I mean, I don't get these maintenance fees for what are they doing? They're holding a digital cert fee. Like that's it.
I have no clue what they do with it. I think they pay their staff for it, and these old buildings that they are still in. They just have other cost structure, I think, than a company like the Hero.
Yeah, yeah. I really don't like paying maintenance fees either, so I would avoid them at all costs.
Yeah.
Jeff has said industrials has just jumped. Did we get some Siemens before it did? I didn't know it jumped. I have an order for Siemens at about 90, I think. I'm being greedy.
Yeah.
Let me check my board. Yes, I have an order at 90, so I don't think it hit 90, so it looks like I missed the boat. But hey, I don't know if they're completely out of the woods yet.
Yeah. I didn't buy either. Yeah, too greedy.
Share price is fickle, isn't it? It jumps 5-6%, and you think you've missed the boat. But I think one thing I've learned from you
No,
is
I just wait
patience.
until it comes
Yeah,
back. Yeah.
patience is key. It will come back, and we'll see.
Yeah.
Phil has asked us a question. So there are a couple of companies with nice profitability, solid balance sheets, however, has a flat dividend and sales. Would the value investor in you still buy them at a good price? Is there anything you would check in particular?
So I really loved this question when I saw it coming in, because yes, I'm European dividend growth investor, but I'm okay with flat dividends from time to time. I'm not okay with dividend cuts. But I'm actually okay with flat dividends. What I want to see is that over time it grows, and that not my whole portfolio has a flat dividend. But even so, then it's just a preservation still of income. And we see a lot of companies that remain their dividend in Europe flat, right? And there are also actually some American companies. We don't see them in the dividend aristocrat list. But I was the other time checking, I saw a company that had like 2 or 3 times a flat dividend that was like in 2009, in 2000, and in 2020. So it doesn't make any dividend aristocrat list, but then you look at the compounding annual growth rate, I think it was 8 or 9% over that whole period.
Yeah.
For me, if this is just conservative management with a good track record in history, I'm totally open for having it, and definitely the value investor is in me there. What I don't like, and I believe, isn't it GSK who has a flat dividend over the last 10 years or something like that?
I think so.
Or is it Pfizer? One of the two. I think GSK.
I think it's GSK. I think
Yeah,
Pfizer has
so
it too.
GSK, I don't like it because there's no prospect at all of a growing dividend. And like if it's 5 to 10 years of flat dividend, it's just too much for me.
But if it's 5 to 10 years of flat dividend with flat sales, I mean, there's no growth there. I mean, that's concerning for me. Not so much the dividend by itself, but the lack of growth
Yeah.
is what's concerning. It's nice that its profitability has a solid balance sheet, but if there's no growth, the chances are
Yeah.
they're going to come under pressure to grow, and to do that they need debt, and they get themselves into a vicious cycle. So it's
Yeah, and I don't remember it 100%, but I thought it was the company GSK. I will look it up later still.
yeah. Yeah, but for me, I've no issue with a certain portion of companies being flat once there's some sort of growth somewhere. I want to see growth, and maybe they're growing and buying back shares or something. But I'd like to see
Yeah.
some sort of growth. But yeah,
I'm
so
looking here. GSK had a flat dividend since, oh wow, since 2013, 2014. Since 2014, a flat dividend, and now a small dividend cut. And I guess that has to do with the spin-off they did of the consumer business. I assume. Yeah.
okay. Mario has asked, Verizon took a big hit, bought 10 more shares, dollar cost averaging in. What are our thoughts? I think we spoke about
Yeah.
them. Um,
Nothing wrong with that.
much better than AT&T, and look, they've done well operationally. It just remains to be seen how much they can grow, but at least their dividend is covered. That's the Gordon has asked us, looking at the top 10 companies by market cap over the last 20 years, one can see a rapidly changing world with few companies still in the top position. Do you ever feel that by picking individual stocks versus index, you might miss the boat on stocks and move on too late from declining ones? It's a good question.
Well, yes, I sometimes think about that. Is the question sometimes, right? Can't you put it just better in an ETF? But then if I look at an ETF and I look at the dividend growth track records, no, and you pay in an ETF for a lot of companies that are also overvalued. So that's why actually I'm always shying away from ETFs. The question here really is like, am I a good stock picker? Probably not. But what I do know is that my stock picking leads to a dividend, fits the best with a dividend growth strategy, because ETFs for me, you cannot count on dividend growth. They just pay out what the dividend companies are paying. So you're really dependent on I said how the index is composed. Yeah, and if you pay a lot for overvalued companies, yeah, then you're still at risk of dividend cuts and such as well at a certain moment in time. And we've seen that with most of the European available dividend ETFs, they almost all of them, they have unstable dividend cuts. And I think always about it, I need to live on these dividends at a certain moment in time. I can't have it that then next quarter they say like, let's do 15% less because our companies are paying out less. So this stock picking just gives me better dividend safety from a personal point of view. And yeah, he's right. Companies today won't be the same. Actually, I'm not too invested about it in the top 10 companies from now either. So
I think I've said it. I go a few times on this show now that I honestly believe that index investing is probably best for most retail investors. Not everybody likes to read 10Ks, 8Ks,
True,
quarterly stuff,
true,
right?
true.
And I get that, but the interesting part of this for me was the last part, which is about moving on too late from declining ones. And in theory, we have we have a strategy, and the strategy is we analyze the companies, and then we look for growth, and if we see a decline, then we start to sell.
Yeah,
And I say, okay, that's my strategy, and then I look at AT&T in my portfolio,
yeah,
and I see them, but I'm not selling them. So it's always a complicated process, and he's right. You can move on too late from one or two.
yeah.
I'd be concerned if I was having that conversation about all 24 stocks in my portfolio. So
But
one is
maybe
not,
you will have this conversation over the next 10 years about 16 stocks in your portfolio, right?
and
And this is real, because from selling is for me 20 times harder than buying. So this risk is definitely here, and specifically for the stocks that are at the bottom half of your portfolio
yeah,
that you monitor less, so you get less quicker also signals. I mean, if let's imagine that Microsoft would become a declining business now, I would be so biased after these years of growth that I will think like, they will get it back.
yeah.
Bad quarter, bad year, bad 2 years. Before you know it, you're 10 years down the road like IBM because you fell in love with the stock.
So
Yeah.
that is always a tough one, and it is a risk. It is the risk, and that's why ETFs are probably better for most. But I would be concerned, as I said, if it does happen, 16 of my 24 companies, I'd be concerned at that point, because then there's a clear problem with me as an investor not being able to let go or not doing what's right for me. I mean, you have a strategy for a reason. One company, two companies, I can let slide, but if it's a trend in the portfolio, then I'd have to look at myself in the mirror and give myself an honest
Yeah.
assessment.
And then most of the top 10, for instance, probably from 20 years ago, is not necessarily that they declined. They just grew not so quick as, for instance, the winner takes all as Google. Yeah.
Yes.
So we also should think about that. If some of them have been probably still compounding, like Berkshire, maybe with 5 to 10% per year. But then there comes Google with 30-40% per year. Yeah. And then the compounding goes a bit quicker, right?
Yeah, that's true. And look, who knows, 10, 20 years. I mean, it's hard to look now and pinpoint who's going to be on top in 10, 20 years. I don't get myself involved in that, because I know mentally that would make me make decisions that are not good for my balance sheet.
Probably companies that we don't even know yet today.
Yeah, definitely. Okay, and the last question then for the day is from Pulkit, and he said, "What's the best way to position size investments when your initial investment is relatively small?"
That depends on your commissions. Yeah, that's what we mentioned earlier. Let's say, so personally, I never like to buy less than €1,000 position size for the commissions as well. But also, I feel then it's more meaningful in my portfolio. I really do sometimes like 400 or 500 euro, but then it's really that I make a buy to start following the company. Yeah, it's more kind of like keep the change kind of thinking. If it goes bust, then fine. And but it's for me really to start following the company.
I mean, what it depends on here is your own strategy. I mean,
Yeah,
we have a very condensed strategy. I have 24. I think you have 40 in
yeah,
around.
something like that.
So we've got really small portfolios, but maybe someone like Dividend Hummingbird, or even the Dividend Growth Investor, they have hundreds of companies in their portfolio. So it obviously depends. If you have a concentrated portfolio, I would make a list of the top companies that you want, and I would buy one this month, one next month, one the month after, and in that fashion. If you have a more diverse portfolio, then I would not bother. I would just buy whatever you want, one share in each of the companies every month, like 10 companies or whatever. So it really depends on what your strategy is. I think people get too, I would say, bogged down in little details like this. I don't think there's a right or wrong answer. Just do what you feel is right. If you want to invest in 2, 3, 10, 1, do it.
Yeah,
Do
but
any
commissions count here, right?
commissions.
If you let's
Commissions
say
count.
have 300 euros to invest on a monthly basis, or 200 euros.
Yeah.
If you buy 10 stocks, right, then you already need to go for fractional shares at 0 commission. But you also know that there are hidden costs in fractional shares and 0 commissions, because it's usually the spread that you pay for. But still, I think that's why I like something like Trading 212 as a platform, because it has fractional shares. You can create your own pie. It is really easy to invest when you are having small amounts, and then you don't need to worry about the position size, right?
Yeah, cool. Thanks a million to everyone for the questions. I mean, there were some pretty good questions. Gave us some good conversations as well. So thank you. I think that's the end of the show as well. So
Yeah. Thanks, everybody. We hope you enjoyed it. Our unsalted opinion about AT&T or SAP. Forgive us for the wording. I'll try to beep it out. By the way, guys, also just join our Facebook group, Dividend Talk. We'll put it in the description of today. And see you next week again.
see you next week. And just before we go, I just want to say thank you to Tony and his girlfriend for designing our new banner. I have to say,
Yes.
I think it's awesome. So I want to call that out. Thanks a million for that. I know we were a little bit picky sending them back in size and stuff, but it was much appreciated, and they've done a great job. So check out our profile, check out Tony's. I think it's Tony 1 million. We'll put a link in our description and check him out. So thank you, and we will see you all next week.